Hello there. Welcome back to Creative Accounting. This video, I want to look at a question of accounting concepts and accounting equation. A question has got 24 marks and requires you to spend on average 19 minutes on this question. So we are going to start with 1.1 where we're having the concepts. And the question reads, choose the correct word or words from column A to match a description in column B, right? Only the letter A to E in column B next to the question numbers, that is 1.1.1 up to 1.1.4. In the other book, for example, I give an example that it should present as 1.1.5 F. And we have got a column A and column B. So we are going to pick our term in column A and match a description that we're having in column B. So the first one is investment. And if you go to our column B, you can go through each and every explanation to see which one do matches investment. But if you go to C, you would see that C reads money tied up for a period of time in order to earn a high return. So if you tie up money or spend money with the intention of earning higher future returns in the future to come, it's investment. So we have got C matching our 1.1.1. Then 1.1.2 double entry principle. We know that double entry principle explains that every debit entry has got a corresponding credit entry, or you can the opposite also. You can also say every credit entry has got a corresponding debit entry. So that is what we call double entry. So if you go to the explanation that I give you, you see that we've got E, which matches that explanation. So we are saying 1.1.2, we've got our E. So we can present our E there. Then we go to the next question, which is 1.1.3, which says a mortgage loan. But you know that mortgage loan is a non-current liability. So we can go try to see an explanation which explains the non-current liability there. So if you go to B, money borrowed in order to purchase property, obviously we are saying this is a long-term loan, mortgage loan. And when this money borrowed in order to purchase a property, obviously it's going to be a huge amount of money, which is also obviously going to be a long-term loan. So we have got B as the appropriate response that we have there. Then we've got investor or investors. So we go through again the responses that we are having there. You would see that A, an individual or group of people who invest money in a business for the purpose of making a profit. So is what you call an investor. So basically, an investor is one who does investment. So basically, that's what it means. So we've got A there is the appropriate answer, or the correct answer. So we go to the next section, which is our 1.2. So if you go to 1.2, it reads on the required part, analyze the following transactions according to the format provided in the answer book. Information, we are given 1.2.1 saying received 1,000 rands from Protea Bank as monthly interest on fixed deposit. So basically, the first thing that you have to do is to identify the double entry verbs. So if you come here, you'll see that the statement is saying received 1,000 rands from Protea Bank. So we are receiving money. So obviously, we are going to debit our bank. Our bank is going to be debited, so debit our bank, and then received 1,000 for Protea Bank as monthly interest, and obviously we're going to credit our interest income or interest on fixed deposit. So we can just maybe say interest on fixed deposit. Then according to the accounting equation, we know that the accounting equation says assets is supposed to owner's equity plus liabilities. So we are going to see that we are going to now check on the double entries, which is being affected in terms of assets, owner's equity or liabilities. We've got bank, which is an asset. Remember, bank is an asset, so obviously it will be E. So when we are debiting an asset, remember when we are debiting an asset, it's a plus. We are going to have a plus, and when credit an asset, it's a minus. The same applies now. The opposite applies to when we are dealing with liabilities. We are going to have a plus on the credit now and a negative on the debit. So this is how it is. And owner's equity, obviously, we check owner's equity depends on what are we dealing with. So we are going to go through as we answer the question and maybe reflect in terms of how to treat the owner's equity. So what we are saying here, we are saying we're debiting bank. So bank, we are saying it's a plus. So it means here it's a plus. And then credit interest on fixed deposits. Remember, interest on fixed deposit is adjusted in the income statement and other income, so it's going to increase the figure for our net profit, and net profit also increases our owner's equity. So obviously, there is also going to be an increase on owner's equity. Basically, what we are saying is there's a positive relationship that exists between net profit and owner's equity. That is, when net profit increases, owner's equity also increases. When net profit decreases, owner's equity also decreases. That's the positive relationship that we are trying to interpret from the relationship that exists between owner's equity and net profit. So what we are saying is on interest on fixed deposit, it's other income, so it's going to increase our owner's equity. It's a plus. The other thing is when we're having our accounting equation like this, we have got two sides that we have, which is this side and this side. This side is for total assets, this one is for total assets, and the other side here is the total of owner's equity plus liabilities. So we're saying if the double entry is affecting both sides, that is the other account is this side, and the other account is this side. If we are having such a scenario, it means all the accounts will have the same sign. If you are having a positive, we are going to have a positive again. If we are having a negative, we are also going to have a negative in the same transaction on the other end. So that's what we have. But if it's affecting one side, all the accounts of double entry are on one side, we are going to have a positive and a negative. In such a way that both sides will still remain the same. For example, if the double entry is affecting owner's equity, one account is owner's equity, the other account is liability. It means one is going to be a plus, one is going to be a minus. And if the double entry is one side in terms of assets, maybe we are going to have, for example, we bought equipment, we bought a non-current asset. It means we are going to debit the non-current asset, so it's going to be a plus. And then we are going to use bank, and obviously bank we are going to credit it because money is going out, so it's going to be a negative. So to be a plus and minus. So that's basically how we deal with when we are treating this accounting equation. So we can go to our answer section and try to adjust as such in terms of our 1,000, whereby we are saying we're going to have a plus under assets and also a plus under owner's equity. So we can go to our answer section. So try to see what we have in terms of. So this is our presentation of accounting equation. So basically what we are saying is we are having an effect on assets, which is going to be a plus 1,000. And the reason is that we are debiting bank. So we can write bank here. And then on owner's equity, we're also going to have a plus 1,000. Reason being interest on fixed deposit. So this is what we have. And then we do have to go to the next transaction and see what we have. So we can go to the next transaction, whereby now we are on 1.2.2, which is here. So we can just try to see how we can adjust that one. So on 1.2.2, we are saying issued a check to G Africa for the purchase of equipment, 24,000 rand. So basically, let's put down the double entry first. Remember, we are debiting. We are purchasing equipment, so we are debiting equipment. And we are crediting. We are using a check, which is bank. So we are crediting bank because we are paying using a bank. So these are the two accounts. We see that these two accounts are all assets. They are all assets. So what we are going to do is equipment we are receiving, we are debiting. So when you debit an asset, we are saying it's a plus, so we don't have a plus here. And when you credit the bank, it's a minus. When you credit an asset, it's a minus, so it's going to have a minus here. So that's what we have. The amount that we are going to be using there is 24,000. So that's how we are going to. So this is affecting one side of the accounting question, which is at the side of assets only, because all the accounts involved in the double entry is assets. So we can go to our other section and try to summarize that. So if you go there, you'd see that first of all, we are going to have equipment. Whereby you're going to have a plus 2,000, it's 24,000. And also there also we are going to have bank, which is now a negative 24,000. like what we said, that if it's on the side of assets, all the accounts are on the side of assets, we're going to have a positive and negative. So this is what we have, and then we can go to the next transaction and try to see what does it has to say. So on 1.2.3 now, Palmer Brothers charged the business overdue account of 4,800 rands with 18% interest per annum for 4 months. So we're going to say 18% of 4,800, then the figure that we're going to get is per annum, which is per year, and then we make a proportion of 4 months, which means we're going to multiply by 4/12. So basically, we are saying 18/100, which is our 18%. We multiply by 4,800, and then we multiply by the number of months which are having, which is 4/12. We do that, the final answer that we are going to get there, let's just try to see what we get. 0.18, we multiply by 4,800, and then you multiply by 4, answer that you get, you divide by 12. Which is going to be 288. So the amount that we have is 288. So this is the interest on overdue account. So the double entry involved there is that we are going to have an effect on the bank, obviously. We are going to have interest paid as an expense. Sorry, we're going to have interest expense as an expense. So whenever we have an expense, we're supposed to debit it, and then the corresponding entry. This is an overdue account, which means this is a creditor. So we are going to credit the creditor's control. So basically, we are saying we debit interest paid as an what? As an expense. And then we credit the creditor's control. Because this interest is going to increase the amount that the creditor is owing. So basically, now when you debit the interest paid, it's an expense and it's going to be charged in the income statement under operating expenses. And then we are going to have a decrease of the net profit. And whenever you have a decrease of net profit, it means the owner's equity also is going to have a decrease. So we are going to have owner's equity having a minus. And then on creditors, remember, creditors is it's a current liability, which is other liabilities. So whenever we credit a liability, it's a plus. So it means we are going to have a plus. So you see that we have got a negative and a positive. And it's a plus on liabilities. We've got a positive and negative. Remember, this on one side, remember our account equation says assets is equals to owner's equity plus our liabilities. So this double entry is affecting this other side, which is this side. So that's why we're having a negative and a positive. So we can just go there and summarize the side. So we come here. We are saying on 1.2.3, we're having interest paid is the reason. And then on the effect, it's going to be a negative interest paid, and we are going to have a negative. It's going to be under owner's equity. Sorry, we can just remove that. Interest paid is going to be under owner's equity here. Remember, I said it's going to affect the income statement. So you've got interest paid, and we're going to have a negative 288. And also on liabilities, it's going to come under creditors control now. It's going to come under creditors control. And the effect that we are going to have on creditors control is a liability. We're going to have a positive 288. So this is what we have in terms of 1.2.3. Then we go to the last one, which is our 1.2.4. So on 1.2.4, we can try to see how are we supposed to adjust that one. So we got there on 1.2.4 is saying sold goods for cash that cost the business 1,800 rands. Goods are sold at cost plus 50%. So the cost price is 1,800. Remember, when we say cost price plus a markup, we're going to get our selling price. So in this case, our cost price, obviously our cost price is always 100%. So it means cost price 100% no matter what. But markup changes depends with the question. In this question, we were given it as 50%. So we have got 50% markup, which means the selling price 100 plus 50 is going to a representation of 150%. So the figure that we are given is cost price, which is here 1,800. 1,800 rands. So the figure that we are looking for is the selling price that we need to do double entry for the sales is the figure that we are looking for. So we can just use simple proportion by saying what we don't have is a numerator, what we have is a denominator, and then we multiply by the given figure. So here we are saying what we don't have is 150%. What we have is 100%. In the given figure is 1,800. So we can just calculate it as such, whereby we're saying what we don't have 150 over what we have 100, and then we multiply by 1,800. We multiply by 1,800. And then we calculate it as such. You see that the answer that we are supposed to get there comes 2,700. So this is the selling price. So this is the figure that we are going to do double entry using sales there, and then we can say now double entry on sales sold goods for cash. So it means we are going to receive money, so we debit bank, and then we are going to credit our sales. So the bank is an asset. When you debit it, it's a positive. We say positive, and we're going to have 2,700. And then for sales, we are going to adjust sales in the income statement, whereby sales is going to increase the value for net profit. If you see it, it increases the value for net profit. So whenever we're having sales, it means our net profit is going to increase. So we are also going to have a plus on owner's equity, because the effect of an increase on net profit is also going to be an increase on owner's equity. So we're going to have a plus at 2,700. This one is 4. This one is for owner's equity, and this one is for assets. As simple as that. So we go to our other section and enter it as such on the first double entry. Remember, this transaction has got 2 double entries. We are also going to make the double entry at cost price. So the first double entry is on selling price, which is at the sales, whereby we are saying we are debiting bank, and it's a plus 2,700. And on owner's equity again, we are going to have our sales and a plus 2,700. Then we go to the cost price now. Right, on the cost price, we can just try to maybe remove this so that we can have some space. So on the cost price now, we are saying these goods are going to be removed from our books because they are now sold. Remember, they are in our closing stock. So we are going to have a double entry whereby we are going to have our cost of sales, and also we are going to have our trading stock. So cost of sales is an expense, obviously it's going to be debited, and our trading stock goods are going out, they are being sold. So remember when we bought them, they were debited to the trading stock account. Now they're going out, we're supposed to credit them. So cost of sales is going to affect the net profit. Cost of sales, we are going to have an effect on net profit. Remember, when an expense increases, net profit will decrease, and owner's equity will decrease also. So cost of sales reduces net profit. And so we are saying here, the effect is that it's a negative 1,800. We are now using the cost price. And then we go to trading stock. We are crediting trading stock is an asset. When we credit an asset, it's a negative, so it's negative 1,800. So this is exactly how we are going to present it in the other section, whereby we are saying we are having trading stock. Whereby we are going to have a negative 1,800. And then we also have owner's equity, we have cost of sales. Cost of sales. And we've got negative 1,800. So this completes our accounting question on the transactions that were given according to this question. So thank you for listening. Those of you who subscribe, please subscribe and share. Let's share the link to our friends who are doing return accounting. As for this video, I'm signing out to meet again in the next video.